Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, November 20th. You are tuned into On Trend, the show designed to keep you on the right side of the trend. Here are the topics in the timeline for today. We're going to look at a low volatility environment versus a high risk environment. We show you the failure to follow through on the piercing patterns that we had Thursday, Friday. We'll look at the Fab 5. We'll compare FANG stocks with non-FANG stocks. We'll show bonds are perking up. And also we'll check on seasonality and sentiment and show you what works better. Comparing a low volatility bullish environment to a high risk environment. So the first thing we need to do as traders or investors or chartists is to take the temperature of the stock market. We need to know what kind of environment we are in, and we need to adjust our trading strategy according to that environment. So I put out an article in Chart Watchers over the weekend taking the temperature of the stock market. There are a number of ways that you can do this. Before, I've used the PowerShares High Beta ETF relative to the PowerShares High Quality or Low Volatility ETF. Today, I'm going to show the Momentum iShares ETF relative to the Minimum Volatility ETF from iShares. And I usually like to keep the ETF family together. In other words, if I'm looking at one Momentum ETF versus another Low Volatility ETF, I want them to come from the same ETF family, such as iShares here. So scrolling down this article, if you look at the chart here, basically we're doing three things. We're looking at the momentum chart, we're looking at the minimum volatility chart in the middle, and then we're comparing the two in the bottom window there. So what we have here is you can see that we were trending up from whatever April there until September in the momentum ETF, and then we got hit really hard there in October. And we had a little high there in mid-October, and we didn't exceed that high. And if you look at the minimum volatility ETF, it also moved higher from April to September, and it also declined into October. But the decline was much shallower. It held up much better. And then you can see on this bounce, it moved above that October high. So it showed some relative chart strength there. And then the pullback was much shallower last week, and it was already bouncing on Friday. So you can see the pullback in momentum was a lot deeper. And then when we look at the comparison, comparing minimum volatility relative to momentum, you can see that performance is pretty flat, from February until October, and then minimum volatility started outperforming. And that's partly because momentum was underperforming and moving down at a faster rate, and minimum volatility was holding up better. And so that led to outperformance. And you can see that ratio hit a new high there. So this tells us that we are in a low volatility environment. We're in a risk-off environment. So the bulls like dull markets, all right? We like a nice, stable, steady, consistent uptrend. And of course, you can see that that's what we got here in September 2017 up until January 2018. And if you look at the one-day rate of change, it got above 1% and below minus 1% a couple times, but it was pretty steady. The moves were not that big. And then we had that big decline in February, and that kind of shook things up. And we had an extended period of above average volatility when we went well above plus 1% in the rate of change and well below minus 1%, even going below minus 2% on the rate of change. And once you get that kind of environment, you're in a totally different environment. You're in a higher risk environment. And then we went back to a dull market in the summer, and we had that nice stable advance. And then we got the hit in October. And once we got that hit, we knew that the environment had changed, all right? We have changed from at least a not bullish environment at best, and at worst to a bearish environment. Because you look at the rate of change, it's exceeding well above 1%, even hitting that plus 2% on the upside and minus 3% on the downside. So this is just too much excitement, and it means we have to adjust our trading strategy accordingly. Now this chart here shows the 8-day rate of change, and it goes back a little longer for some perspective. And you can see here that we had these downside shocks in 2015 when we went below -4% over an 8-day period. And those are big declines, all right? And when we had those big declines, we were not on trend. And then we didn't go below -4% for over a year here. All right, this was basically the salad days, you know, when we had a nice strong uptrend. And then we started going below -4%, had a little period when we held above -4%. And then in October, we've got at least 3 readings below -4% in the last 2 months. So that tells us that the character or the nature of the market has changed. So what kind of adjustments can we make for a high volatility environment? Well, first you can raise cash and reduce your exposure. All right, the less you have in, the less psychological damage it's going to do. Second, you can get selective and more defensive in your picks. Third, you can look to diversify away from equities, possibly into commodities or bonds. You can also lower your expectations, especially if you're actively trading in this environment. You might also look to book your profits a little bit sooner instead of riding your winners. And beware of seemingly big breakouts, because in a volatile environment, you're going to have some pretty big swings, and some of these breakouts or breakdowns even are not going to hold. Now we're going to turn to the major indexes and look at some failures at the 200-day moving averages and also some failed piercing patterns. So to return to this S&P 500 chart, which kind of acts as our barometer for the market, you can see that big slice through the 200-day, and you tried to get back above it, but failed, and now we're back below it. The 50-day is moving down, so I would look at these failures at the 200-day as negative, and we clearly have a line there at 28.25, and unless the bulls can get above that level, you know, I think we're clearly in a bearish environment at worst and a choppy environment at best. Now, if we scroll down and we look at the NASDAQ 100, we can see that it bore the brunt of the selling pressure over the last week or so because, you know, it had this nice move up, but it failed in the 50 to 62% retracement zone. So you had a big move down, you had what is a normal retracement, and then we just broke down again. And that is the lowest close since early May. So the NASDAQ 100 is leading the way lower, and that's not a good sign either. Then we look at mid caps. They're not doing any better. You can see that death cross there with the 50-day moving average crossing below the 200-day moving average. And we bounced, but we failed at the 50% retracement. Didn't even get into that zone there and fell back. Then we look at small caps, and we can see that the 50-day moving average is right at the 200-day moving average. We didn't even get to the 50% retracement. So mid caps got to the 50%, but small caps didn't, and then moved back down. So the longer term charts are not looking so good here. Now, I highlighted some piercing patterns yesterday, and these are short-term bullish candlestick reversal patterns. Now, the big caveat here, all right, I usually ignore short-term bullish setups when the broader market environment is either bearish or not bullish. And I think the broader market environment is bearish. It turned bearish with this big move down on October 12th. My indicators, my breadth indicators turned bearish. And the reason I highlighted is because I was reading up on Dow theory and Elliott wave. And in Dow theory, they talk about the secondary move. All right, so if we consider this a primary move, in other words, the first leg down, secondary moves are often fairly robust, at least seemingly, and they can retrace a good portion of that first move down. And Elliott wave says the same thing. You know, sometimes you get a wave one down, but that counter trend bounce, that first bounce is really strong, and it gives the bulls hope that the bear market has not started and the bull market is alive and well. And that's why I would be careful if we got a breakout here. But, that's neither here nor there. What I'm focusing on right now is the piercing pattern that formed. And I showed this on Monday. It formed on Thursday. So you have this black candlestick, and then the white candlestick opens weak and closes above the midpoint of the black candlestick. And you can see this gap zone. So you had some reasons for support. You had the piercing pattern. I'll get into sentiment a little bit later. And we didn't get follow through. We needed a breakout at 275 to confirm that piercing pattern. And instead, we fell back sharply on Monday. But we're still in the gap zone. And 275 is still the first level to watch. So if we get a breakout there, maybe we get that move to 284. Now I'm really getting out the crystal ball because, I'm looking into the future, and that's always really dangerous because it rarely turns out the way you expect it. Expectations are dangerous. But, no breakout at 275, well, no wave C. And we clearly don't have that right now. So if we get a breakout at 275, maybe we get up to 284. And, if you get up to 284, you can imagine what the narrative would change, and it would be quite bullish. But that could be an Elliott ABC correction. And again, I'll cross that bridge when and if it gets here. I'll look at my breadth indicators to see if they change. But the bottom line here is we haven't had a breakout to confirm the piercing pattern. And until we get a breakout at 275, the odds favor a move below that October low. So if we look at QQQ, and here's another reason to be negative, you can see that piercing pattern there for QQQ as well, and massive failure there because it declined below the low of the piercing pattern. So that's not an active pattern anymore. I guess this is still a resistance level to watch. 169, a breakout would be short-term bullish. But, keep in mind, lower those expectations. All right. Lower the position sizes. I should have added that one in there. This is a volatile, risky environment. And so you need to take less risk, I think. Here's MDY. Now it's holding up a little better. All right. This is interesting. You can see the decline is not as steep as it was for SPY. And it's above this gap zone still. So, its piercing pattern might be working. And, it's kind of like an inside day. It's inside that piercing pattern almost. But still, if you get a breakout there, and that's going to be bullish for MDY. So that's one to watch. And I noticed the finance sector has been holding up pretty well lately. So if we get a bounce, maybe MDY will lead it. And then if you look at small caps here, there you can see the piercing pattern. And you fell back, and we need to clear that resistance level. So look for, 2 of the 4 here, 3 of the 4 to break out to suggest that we're going to get some sort of counter trend bounce. But no breakout, no bounce. Now we're going to look at 8 FANG type stocks and compare them to 8 non-FANG type stocks. So first we're going to start off with Apple here. And on this chart, you can see Apple has kind of some resistance there that might come into support. And so, maybe it's coming into a support zone here from these resistance levels. And I'm sure if you drew your Fibonacci retracements, we're coming into the 50 to 62% retracement zone. And we're getting oversold there. As you can see, RSI is moving below 30. Now, that is a short-term issue that may give way to a bounce. But, when we look longer term, we're below the 200-day EMA, furthest below we've been in a while. We had these dips in February and in April and recovered pretty strongly after these dips. So this is what to watch for. We're in a potential support zone. And if we can get a big surge above this 200-day, maybe we'll put in some sort of a low for Apple and the FANGs. Now, when we look at Amazon, its chart looks a little bit weaker because you can see it move below the 200-day in October and then back below here in November. So, maybe there's a support zone coming in here in that 1350, 1400 area. But clearly, it peaked in early September and it's kind of leading the way lower. Then we look at Facebook. This is one of the weakest of all here because you can see it's hitting a 52-week low. And it all started with that big gap down. And Facebook never recovered from this gap. It just started working its way lower. You know, even when it had that pop there at the end of October, it just fell right back to new lows. So Facebook clearly is broken. We look at Google, it's not acting much better than Facebook. And when you look at these charts, you need to keep in mind that, you know, the S&P 500 peaked here in September. All right, Google peaked in early August, so it was already down when the S&P 500 was at a new high here. So it was already showing relative chart weakness. It broke the 200-day in October and continued lower. You can see the 50-day is below the 200-day. So this is one of the weaker issues, and it needs to get back above 1120 to get any sort of an uptrend going again. We look at Netflix. Again, you know, just keep in mind when the S&P 500 peaked. The S&P 500 peaked here. All right, Netflix peaked way back in June, so it was already underperforming for a few months, and now it is below the 200-day, and that closing low there is the lowest since February. Nvidia, oh my God, what a train wreck this one turned out to be. And you can see here that it was keeping up with the market because it had a new high in September, and then all of a sudden, out of the blue, it broke below the summer lows here. And these were kind of benchmark lows. And, you know, the leaders were holding above these summer lows in October, and the new laggards were breaking below, like Nvidia. So Nvidia basically went from a 52-week high there in September and in a matter of weeks to a 52-week low. This is an amazing about face here. So clearly risk is coming off. Now here's one that is, I don't know if it's a FANG, but you know, clearly when you think of risk and you think of the new world order, if you will, stocks that are going to, you know, at the leading edge of technology, Tesla pops up there, you know, and look at Tesla, it's performing well. All right, it was lagging in September because it was below these highs, but it's leading since mid-October because it broke out there and it's holding this breakout. Now, it's still a very risky play, but it is looking the best out of these stocks right now. And Twitter. Twitter got a nice little bounce back above the 200-day, and the 50-day EMA crossed above. But yeah, I'm not buying into this bounce because of the weakness in the other ones. So Twitter may be about to go lower. All right, now let's look at 8, how should we say, companies that aren't as exciting, a little more boring. All right, here is Comcast. And you know, Comcast was acting like a defensive issue because it declined in the first part of the year, the first 5 months, and then it has been advancing in the last 5 months here. You can see from June until November. And there's the high in September, and it actually moved above that high. So Comcast is holding up a lot better than the broader market over the last few months here. Then we look at Cisco. All right, Cisco is also holding up better. Now, this doesn't mean I'm looking for lots of positions to buy and to increase exposure in the ones that are holding up. But, you know, usually if something is holding up during a broader market decline, it tends to lead if the market comes out of its funk and starts to bounce. And, you know, you look at Cisco, here's that September high. So it was keeping pace with the market in September. And it almost reached that high here in early November. All right, it fell back really sharply last week. But I think, you know, there's a lot of congestion in here to mark support. And so this is one I would keep on my radar if the market is going to bounce, because I think it's holding up better than the broader market. You know, we could even draw a triangle here of some sort. So we got a triangle consolidation working. We look at Disney. Now, Disney it got hit yesterday, but it's holding up better than the broader market. There you can see the August high and the September high. And then we got a higher high in October, intraday higher high in November here. So it is working its way higher. it's not going to be immune, I don't think, to broader market weakness. So you can see it is struggling a bit, with this advance, because if you look at the beginning of the advance, it was very sharp, and then you had a pullback and you had a really nice move up, but then the broad market turmoil hit, and you can see this advance started getting choppy. So it's still a lot of hesitancy in that advance, if you will. All right, here is Intel. Now, Intel is clearly lagging, and it peaked here in June. So it's been lagging for a long time. But if you look at this period right here from October until November, from the middle part of October to the middle part of November, you can see that it is starting to hold up a little bit better. And you got a resistance level there at 50. The 50-day EMA is turning up, might be about to cross the 200-day. So what kind of looks like is maybe you have a consolidation working here, and if you get a breakout there, that might be bullish for Intel. But I think the bottom line is it's holding up really well over the past 4 weeks or so. Johnson & Johnson is one of the leaders, and it's powering the healthcare sector. I featured it in Don't Ignore This Chart when it kind of had this triangle. Yeah, it's maybe a sloppy triangle, but the essence of the pattern is there, in that you have a surge, and then you have this consolidation to digest the surge, and you had a clear breakout there around 140-ish. JP Morgan Chase. Now, this is one that has gone nowhere for the entire year. All right, it started 2018 down here around 105, so it is up a little bit. But you can see for the most part, it's just been one big trading range that it's been locked into. What I'm noticing, though, is you had this surge in this gap, and then we had a pullback, and we've moved up here. And JP Morgan was up yesterday when the market was down sharply. So finance is holding up better. I think JP Morgan is holding up better than XLF, because if you look at this summer low here, it actually held above that summer low, whereas XLF moved below it. So, JP Morgan's the best in a bad group, I think, because finance has been lagging all year, but it's been showing some relative strength the last few weeks. Microsoft, it got hit and took the software group with it. You can see here, it looked like there was a breakout there, kind of a little flag breakout, but this has failed. And this is what I mean with lowering expectations and lowering exposure, because, in this kind of environment, you're going to get more failures, more whipsaws than you're going to get successful trades. And PepsiCo, we want consumer staples. All right, if you look at PepsiCo, had this big move up, a correction, and then it got the breakout in October when everything was moving down. And look at that, it's at near a 52-week high. So in another sign of risk aversion, bonds are starting to perk up and outperform. All right, so I've got here the unadjusted 7 to 10-year Treasury bond ETF, which means the distributions are not added back into the chart. It's pure price action. And below, I've got the 10-year Treasury yield. The long-term trend is clearly down, all right? You had a 52-week low there in October, and in the 10-year, you had a 52-week high. And then we got this flag, this kind of rising flag, and it looked like we were breaking down in early November. And on the 10-year Treasury yield, you had a falling flag and a breakout. So it looked like we were ready to move lower again, but you can see sometimes chart patterns and setups don't work out like you expected. So when something happens as not expected, like this breakdown here did not hold, and this breakout here did not hold, and instead we've moved above this high here. So we're starting to see strength in the bond market. We're still below the falling 200-day moving average, but money moving into bonds suggests a bit of risk aversion in the market if the money wants to go into safe haven bonds. We look at the TLT, the 20 plus year Treasury bond ETF. It's right at resistance from those October highs, but it's been moving up in November. And the 30-year Treasury yield is right there at 33, which is 3.3%. So a break there would be short-term negative. And if you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. I can't answer all of them, but I promise to read them and take them into consideration. So the question I got this week was, do you use sentiment or seasonality? So let's take a stab at that. So before looking at sentiment and seasonality, I need to qualify these. Sentiment especially can be very fuzzy because a lot of these sentiment indicators are based on surveys. Second, you got to keep in mind that these indicators can stay at extremes. You can have excessively bearish sentiment in a strong downtrend, and it can remain at excessive bearish levels. Third thing is sentiment and seasonality are not very good for market timing. They just kind of give you an idea of when we're at an extreme or when we're at a seasonally bullish or bearish period, but it doesn't help you with timing. And at the end of the day, nothing beats the price chart. Sentiment and seasonality are indicators that are far removed from the actual price. And at the end of the day, you need to look at the price chart and take your signals from the price chart. If you get a signal on the price chart that matches what you're seeing in sentiment and seasonality, then it carries a little bit extra weight, but you need that signal from the price chart. So two of the fuzzier sentiment indicators would be something like the CNN Fear and Greed Index, which is at an extreme. We also have the American Association of Individual Investors, the survey that they have, and you can see the bears outnumber the bulls. If you want something a little harder, you can go to Jason Gupfert's blog, Sentiment Trader. He writes about sentiment. He's been writing about it for years. And also, we cover sentiment on a regular basis at Market Watchers Live. Aaron does a sentiment update on a weekly basis. So here is the National Association of Investment Managers Exposure Index. And when this level is low, it means there is a lot of cash. In other words, they're only, say, 35% invested now. But you can see it can get down to this 20% level, all right, like it did in 2011, 2014, and 2015. Also in 2008, you went below 20%. And you had a number of dips below 20% as the bear market extended. So these can move to extremes and stay at extremes. Next up, we have the put-call ratio. And this can move to an extreme, but the extremes can shift. So you can see here in March, we had a lot of put buying, and that gave us a bottom. And we had a lot of put buying at the end of October, and that gave us a bottom. So this one worked so far. We'll see if this bottom holds because we've already turned down. And then, of course, we have the seasonality charts. And if you scroll down on the free charts page, you can enter $SPX to see the seasonality chart for the S&P 500. And if I open this up to 20 years, you can see that November and December have been bullish over the last 20 years, up 70 and 74% of the time. So that's something maybe to consider, but again, watch the chart. Keep in mind that the S&P 500 is now down so far in November, so this does not work all the time. Nothing works all the time. You need to look at the price chart. Now you can go down to the bottom there and you can enter another symbol if you want to see how Russell 2000 small caps have performed over the last 20 years. Just enter the Russell 2000 and go out to the max, and you can see it's got a bullish bias as well. And that concludes this edition of On Trend. Thanks very much for tuning in, and I wish everybody a happy and safe Thanksgiving weekend. Take care.